everyone to another webinar series by Fort Pitt Capital Group. My name is Beth, Lynch, and I'm joined here with Kaitlyn Haney for Women, Wealth, and What You Need to Know. Many of you are clients of the firm, but we also know that we have lots of friends and family that have joined us today. So for those that don't know a little bit about Fort Pitt Capital, we are a wealth management group where we do investment management and financial planning. We do all of our research and investment decisions are done in-house. We are fiduciaries. Our clients are assigned to a dedicated team of advisors so that their needs and goals are met, and we get to really know our clients. We really want to create really great relationships with our clients, and we pride ourselves on the exceptional client service that we give to our clients. We do this by having a holistic approach to financial planning and our transparency. So you always know what you're paying and what you're getting. We started our webinars years ago, probably right around COVID, to continue to educate our clients and keep them informed of different things that were going on in the economy and just different areas of financial planning. But we don't want to see ourselves just as financial advisors, but really life advisors. We've offered these free webinars not only to our clients, but to the community. The whole idea is to empower and to educate everyone so that as you're tackling life questions, maybe we can answer those or help you and give you a resource to reach out to have your questions answered. A little bit about myself. Again, Beth Lynch, I'm a certified financial planner. I've been with Fort Pitt Capital for about 6.5 years. I have been in the financial planning and investment advisory role for 30 years. It's hard to believe that it's 30 years that I've been in this industry. And I've had my CFP for 20 years. I really enjoy working with individuals and families on their financial planning, on their needs, creating goals, putting together plans so that they can achieve those goals. I especially love working with women clients, making sure that they're empowered, taking the craziness out of investments, the scariness out of it, and really talking to individuals about how to invest, why it's not scary, and guide them through the financial planning process. With that said, I'm going to let Kaitlyn introduce herself.
As Beth said, my name is Kaitlyn Haney. I also am a certified financial planner here at Fort Pitt Capital Group. I've been with the firm just a little bit over 6 years now, and I've worked with Beth on Beth's team with her for 4 years or so. So I came to the firm straight out of college, and I worked my way up to becoming a financial advisor, and it's truly what I love to do, helping people answer their questions, make sure they're making good decisions with their finances and with their money, and just helping them navigate the murky waters that are finance. You wouldn't believe the number of questions and individuals who aren't sure about things that we deal with every day, and it seems so novel to us, but I love answering those questions and empowering, like Beth said, everybody to really feel like they have control over their financial scenarios.
Thanks. So as we go through the webinar, here's a few ways in which you can interact with us. Unfortunately, we can't see you. So hopefully, you laugh at our jokes if we have some of those, and that you're not sleeping on the other side. So we're here to hopefully continue to entertain you and actually educate and empower you. So with that said, how to interact. If you're on a device, you can just tap your screen to ask a question. It is up in the top right-hand corner of your device where there's a little message box where you can get ask a question or get the handouts. Now, if you're on a computer, a little bit different, still in the top right-hand corner, but you can see the little box with a little question mark in there, and the handouts are also at the top right. If you have a question to ask, you can just type it in the bottom right-hand corner, and we will try to address those if we can during the webinar, but most likely we'll keep most of those questions for after so that we can hopefully get through the presentation. But if it's relevant and it comes through during that portion of the webinar, we'll try to answer those questions. And again, where the handouts are, you can click that. Not too many handouts in there, but feel free to learn a little bit about Fort Pitt and our process. With that said, I'm going to turn it over to Kaitlyn for her to talk about small business owners, retirement plans, the types of plans that are out there, and how you can save.
Thank you. So we have three main ideas that we are going to discuss in detail this afternoon. And the first one, as Beth said, is retirement planning for small business owners. This is an increasingly more important subject for women, as we are not only the majority owner in over 35% of U.S. employer firms, but we are also the owners of 13.8 million businesses, employing over 10 million workers across the United States. So those are some huge numbers where women have really taken charge. And although we are leading that revolution in female entrepreneurship, women on average have only a third of the retirement savings as their male counterpart. And that is why we are talking about this today. For small business owners, there are three types of retirement plans that are relatively easy to establish for yourself, for your business, that we're going to focus on. We have a solo 401k, a SEP IRA, and a simple IRA. These retirement plans all can and should be invested in an investment portfolio. Most custodians offer a wide range of mutual funds, stocks, bonds, ETFs to invest in. Additionally, each of these accounts offer similar tax benefits, tax-deferred growth, as well as tax-deductible contributions for your business. Contributions made by the employer are tax-deductible for the employer, so your business has the opportunity for some tax savings. So when does the government get paid? Because we all know the government is looking for their tax dollars at some point. Regardless of your age, withdrawals are taxable as ordinary income, so just like your current paychecks. In an attempt to encourage savings and deter premature withdrawals, there is also a 10% early withdrawal penalty from these accounts for anyone who withdraws before the age of 59 and a half. So to put a little perspective on that, let's say you're looking to take $10,000 out of a solo 401k at the age of 40. If your income is currently being taxed at 20%, you're probably going to need to take about $14,285 to be exact. So just about $14,300 to get that $10,000 that you requested. That's over almost $4,300 in taxes and penalties alone. Each of these plans would also be subject to the required minimum distribution rules, which are also taxed as ordinary income. So as of January 2023, the Secure 2.0 Act went into effect, and individuals born before 1960 are going to be required to start those minimum required distributions at the age of 73, and individuals born 1960 and later will begin taking their distributions at 75 for now. So let's take a look at some of those plans that we mentioned in a little bit more detail and how they're different. First retirement plan is the solo 401k or a self-employed 401k. And we did have a question on this topic. Somebody wrote in when they registered about what is the best plan for retirement for a solopreneur. And this might be one of those plans that you would want to consider, because this plan is for usually somebody with just one employee, like we said, a solo individual. Your spouse may also participate in the plan if they too are a compensated employee. But if you have other employees, this most likely is not going to be the plan for your business. Contributions to your solo 401k will come from your salary deferrals and from contributions from your company. So these employer contributions are considered an employer expense, which will help overall reduce net profits and therefore reduce tax liability. Contributions are limited just like a standard 401k plan. So for 2024, and these numbers will most likely adjust every single year, employees can contribute $23,000 annually, and individuals over the age of 50 are able to make additional catch-up contributions of $7,500. So a total of $30,500 could be deferred by the employee alone. Between you and your business, a total of $69,000 can be contributed on the behalf of each participant. So in theory, if you're a 50-year-old or older individual and you're maxing out your contribution, your business can also contribute then $38,500 to really max out your savings opportunity. These plans can be established and funded by your business up until your business's tax filing deadline, including extensions. So April 15th or October 15th of the following year. Your salary deferrals deadline is dependent on the type of business that you have. So if you have a Schedule C, income, a sole proprietorship, or a single member LLC, a C Corp, you can make salary deferrals up until your tax filing deadline. The caveat is if you have an S Corp or a partnership LLC, you will only have until March 15th of that following year, including a 6-month extension. And the administrative requirements are pretty limited for these plans. The IRS requires a filing at the termination of the plan, and in some cases there will be annual filings required. The second plan is a SEP IRA. SEP stands for a Simplified Employee Pension, which will make a little bit more sense in a minute. And this is an ideal plan for businesses with only a few employees. Ideally, if you're the only employee or if you have less than maybe 5 or so, but you want to keep it pretty limited. This may also be good for plans or for businesses if you have high turnover of employees. Maybe you have a lot of new college grads coming in, gaining experience before the next stage of their career or education. When you establish a SEP plan, you would also need to complete a plan agreement, which outlines the requirements to be eligible for participation and how contributions will be determined. So you can set a service requirement, meaning the employee must work for you for a certain amount of time before they're eligible for the plan. And this protects really your business's obligation because this plan will be funded with your contributions, but it also encourages folks maybe to stay a little bit longer with you so your training efforts aren't wasted. The limited number of employees is recommended as these accounts, like I was saying, are funded by the employer only, similar to traditional pensions that we hear about, but we're used to hearing about. Employees are not able to make salary deferral contributions to these accounts. So a SEP IRA is favorable over a traditional IRA as the contribution limits for the SEP IRA are much higher. While contributions are limited to 25% of the employee's compensation, they can max out at $69,000 for 2024. Again, these will fluctuate annually, these limits. This year, you can max your traditional IRA contribution at only $7,000 or $8,000 for those over the age of 50. So there's huge potential for higher savings in a SEP IRA. These plans can be established and funded up until your tax filing deadline, plus any applicable extensions that you file for. And the administrative requirements are fairly limited, but they're a little bit more involved for these plans. The noted we have on the slide, Form 5305 SEP, that's the adoption agreement that I had mentioned earlier. You can use either the IRS's version or the version provided by your plan's custodian. Again, this will detail the years of service required for the employee, a service required, or usually it's limited to about 3 years of service that's required of the last 5 years that they've been with you. Employees must also notify their employee of any contribution that's been made on their behalf.
So we did have a question that came in on small businesses. What defines a small business? Does someone who's a 1099 contract employer count? So interpreted with multiple contracts through agencies.
Yep. So if you're a 1099 employee, a SEP IRA is a great option for you. Really small business, I would define as anything in the scope of these 3 plans is under 100 employees because our next plan comes into that 100 employee limit. But like we said, for the solo 401k, you're looking at really only yourself. Maybe your spouse is working with you. A SEP, you want very few employees. I would say 5 to 10 even. So you don't want too many with the SEP.
And I also follow this up with, that's definitely something you would want to talk to your tax professional about. How you as a 1099 employee can take advantage of the different plans from a tax standpoint.
Definitely. Always consult your tax professionals. So finally, the third and final plan that we'll cover today is the Simple IRA. And that SIMPLE stands for a Savings Incentive Match Plan for Employees. This is ideal for businesses that have less than 100 employees, and it's really required for only having 100 employees. Anything over that, you cannot qualify for the SIMPLE. And you also cannot maintain any other type of employer-sponsored retirement plan. So you can't do a SIMPLE and a SEP. These plans are also require the adoption agreement that we mentioned previously, which are going to lay out, like we said, the requirements to be eligible for participation. Specifically with the SIMPLE, employees are usually required to have earned income or have earnings of compensation of $5,000 within the last 2 years, and they need to be expected to earn $5,000 within that current year. And this can be adjusted, but these are the maximum requirements that you can set. Simple IRAs, they can be funded from both employee salary deferrals as well as employer contributions. So for 2024, employee contributions are limited to $16,000, and individuals over the age of 50 get to make their additional catch-up contributions of $3,500. The employer contributions can be determined in 2 ways, and this is where they're a little bit more complex than some of the other plans. You can either do a 2% non-elective contribution or a 3% matching contribution. And the 2% non-elective contribution is a contribution of 2% of each eligible employee's compensation, regardless of how much the employee defers to the plan. The 3% matching contribution is a dollar-for-dollar match on employees' elective salary deferrals up to 3% of their contribution. If you have over 25 employees, so between 26 to 100 employees, you can offer a 3% non-elective contribution or a 4% match. Employers are also able to make additional non-elective contributions as long as it is in a uniform manner to each participant of the plan and is limited to the lesser of 10% of the employee compensation or $5,000. So the SIMPLE plan must be established by October 1st of that applicable tax year. Employee salary deferrals must be made within 30 days of the date that they would have otherwise been paid to the employee, but your employer contribution can be made up until the tax filing deadline of that year plus your extensions. So with that, I'm going to now pass it over to Beth, and she is going to cover our Social Security planning segment.
Perfect, thank you. So Kaitlyn started with the retirement, and we're going to save as we're aging and entering into retirement. And a lot of things that biggest topic that people think about when they think of retiring is Social Security. And Social Security planning is very complex in the sense that there are different ways to maximize your Social Security. And so how do you do that? And as women, what are some of the complexities or the caveats that we may encounter due to kind of the circumstances that we follow? So that's what we're going to chat about today. And here's our reality, right? As females, in general, women have lower lifetime earnings, lower pensions, and we live longer than men. Women have made a lot of strides in the workplace, but there's still a little bit of a pay gap. Currently, on average, women earn about 82 cents for every dollar earned by men. So this translates into lower retirement savings, lower pensions, which encounter lower Social Security benefits. Yet we tend to live longer than men. So we need these resources, and we need to know how to get them and maximize them. And the reason a lot of these things happen is many women leave the workforce to raise children or to care for an older aging adult, may go back to school. And so we have this break in income. And because of that break in income, our Social Security benefit isn't calculated as high as a male who has worked continuously and has increases. So these are some of the things. And then also, we live longer. My father was in personal care for a little over 5 years. And I can definitely tell you that there were a lot more women in that facility than there were men. And he would tell me that he would have to shoo the women out of his room because he's like, these women just keep coming because there's only a few men here. So he would always joke about the women coming into his room. So because you might be entitled to more than one benefit, here are some questions that you would want to ask. First, do you qualify for a benefit on your own work record? If you paid into Social Security for at least 10 years, then yes, you qualify for your own Social Security benefit. Social Security takes a look at that 10 years. So if you have at least 10 years, you qualify, like I said. And it doesn't have to be consecutive. So if you worked for 5, took a little break, and then continued to work longer for another 5 years, then that counts. So you would have qualified for your own Social Security benefit. Second, something I always ask clients as they come in as single women or men, quite honestly, is, are you currently married? Has your spouse started taking Social Security benefits? This is important to know so that you can match up a claiming strategy. And third, this is a question I usually ask, is prior marriages. This is something people don't think about telling us as we meet new prospective clients, is, have you been married before? And if so, if you meet certain requirements, you may qualify for a benefit on a former spouse's work record. So, for instance, if it depends on if the marriage ended by death or divorce. So if by divorce, the question we always ask is, did it last at least 10 years? So from the date of marriage to the date of divorce decree, was that 10 years? If so, you may be eligible for a benefit on your divorced spouse. Is that ex-spouse still living? Will you get a benefit, a retirement benefit, not a survivor benefit, but a divorced spouse benefit if they're still living? The other is, are they over age 62? 62 is the earliest we can claim Social Security. So we'll talk about this in a little bit, but they need to be at least 62 in order for you to be able to claim on a divorced spouse. Now, a little caveat to that too is, don't worry if you claim on a divorced spouse. That does not change their benefit, or if they've remarried, you are not taking money away from them. It's just something that you're entitled to from being married to them for 10 years. And I have a few jokes there, but I won't go. So the next one is death. If your former spouse is deceased and you are currently married, did this marriage occur before the age of 60? Was it before or after? So 60 is going to be the number when it comes to survivor benefits, age 60. So you're going to want to think about that. Sorry, that's okay. I'm going to flip the slide here. Sorry. Okay, so depending on your answers to the previous question, you could be entitled to one of the following benefits: retirement benefits, spousal benefits, divorced spouse benefits, or survivor benefits. And how you coordinate all of these benefits is crucial in determining your overall Social Security income. Again, we want to help you maximize your benefits of Social Security, and there's different ways that you can claim, and when you claim is so important. But before we get to when you claim, let's first talk about the concept of what is full retirement age. What does this mean? When is my full retirement age? So this is the age in which you can claim unreduced Social Security benefits. And a lot of people, like I said before, they think at age 62 is when they start thinking about Social Security. However, if you claim your Social Security at age 62, it will permanently be reduced. So it's something you need to think about. Now, to get your full retirement benefit, you need to wait to full retirement age to claim. And this differs depending on the date in which you were born. So if you were born between 1943 and 1954, your full retirement age, or FRA, is age 66. Born 1960 and later, your full retirement age is age 67. And you can see from the chart on the screen here that if you're born in those odd years between 1955 and 1959, you're 66 in so many months. So you want to take a look, see what your birth year was, and that'll give you an idea of what your full retirement age is. Again, what the date in which you can claim unreduced benefits. So let's talk about those benefits and what that looks like. So the next thing we want to talk about is our primary insurance amount, and I'll sometimes refer to it as your PIA. And this is just your benefit. It's just a fancy word for your benefit. And I'm not going to go into the formula. I will bore you, put you all to sleep if we talk about how this formula is generated and how they determine your PIA. So, but all you need to know is that the system is going to use your highest 35 years of earnings to calculate your benefit. The higher those earnings are, up to the annual Social Security taxable maximum in this year in 2024, it is $168,600. The higher your benefit will be. So this is one reason we encourage women who have stopped working at some point to continue to work a little longer. If you've taken some time off, raised children, gone back to school, this is a way you can increase your benefit, is by going back to work or working a little longer and increasing your income so that the calculation gets you a higher benefit. So if you keep working, you may be able to replace some of those zeros, those years that you didn't work, with at least something that gets you a higher benefit at some point. So to find your primary insurance amount, I always tell people, make sure you log on to the Social Security website, myssa.gov, I believe, to find your statement. If you're age 60, they start mailing those out to you, but you need to sign up. And this way you can check your earnings income record also. Once you get on there, you can see everything. You'll see this statement, and this is what they mail to you. And you can see from the arrow that this individual, they were born in 1962, so their full retirement age is age 67. And at age 67, this individual would receive $2,119 per month. And this is their PIA, or their primary insurance amount. Now, what happens if you claim at 62? You can see that at age 62, you get a reduced benefit. And I talked about this earlier. Once you claim, that reduction happens, and that percentage is going to be reduced for the rest of your life as while you're claiming. So in this instance, at age 62, your benefit would be $1,465 per month, or 70% of your PIA. So in each year that you wait, you can see that it increases a little bit more, but it's reduced. And if you claim and you are still working, you claim early and you are still working, there's something called an earnings test. And this year, if you make more than $22,320 and you are claiming Social Security, your benefit, that PIA, will be reduced by $1 for every $2 over that $22,320. So let's go to the other side of it. Let's say you are now retired and you're age 67. You could claim, and even if you worked part-time, you can earn as much as you want once you're at full retirement age, and your benefit will not be reduced by that dollar for every $2 over once you're at full retirement age. But even better, let's say you hold off until you are 70. This is where we want to try to hold people off to get the max benefit. For every year that you wait after your full retirement age, you will receive an 8% delayed credit. So a guaranteed 8% increase in your PIA for every year that you wait up until age 70. At age 70, they stop giving it to you, so you want to claim by age 70. Not only do you get your 8%, but you'll also get a cost of living adjustment. And I always tell people that the cost of living adjustment is phenomenal. And I look back at 2022 when that cost of living adjustment, because where inflation was, we all remember where inflation at almost 9%, individuals that were receiving Social Security got an increase of 8.7%. So if you didn't take it and you were past full retirement age, not only did you get your 8% delayed credit, but you got your 8.7. So you got a 16.7% increase in your benefit amount. So the big question, when to apply? This is very complex and it really does require customized analysis. That's what we do for our clients. We run scenarios that show you when you, for your specific need, should apply for Social Security. If you apply early, like I said, your benefits will be reduced, and that benefit starts out at some fraction of your PIA, and it remains at that percentage for the rest of your life. So your benefit amount is locked in the time you apply, and it only goes up with the annual cost of living adjustments. So those cost of living adjustments magnify the impact of either early or delayed retirement, because those annual cost of living, or those COLAs, it's applied to either that lower amount because you've claimed earlier, or the higher amount. So, the power of compounding on that higher amount can really increase your benefit as you age. And that's what you want. You want something that's going to grow with you, because let's face it, we're seeing a lot of inflation today. Can you imagine if we don't have those costs of livings? And this is a primary income source for most individuals. So the when to apply question impacts survivor benefits as well. In fact, if your spouse is earning more than you did, and their PIA is higher than yours, it's even more important for them to delay their filing. This will increase your survivor benefit. I know this sounds crazy and people want to take their benefit, but if you can hold off and let that higher earner or the higher benefit wait until age 70, when that individual passes, you're going to step into their benefit. You don't get two benefits when someone passes, but you'll get the higher. And if you should predecease, then they are going to also still continue to get that higher benefit. So, knowing when to claim and how to maximize that benefit is very important. Spousal benefits. So spousal benefits are 50% of your spouse's PIA if you apply at your full retirement age. So this is really important. The other caveat to it is your spouse must have filed. So for instance, let's say that you did not qualify, you didn't work, you don't have your own benefit, you can still get a spousal benefit. And if there's an age difference, you want to make sure you're coordinating that correctly, because you want to get the max out of your benefit or your spousal benefit. So in the example here, John and Jane are married. John's PIA, primary insurance amount, is $2,400 a month. So John files for his benefit at age 67, and Jane's also 67. They're the same age. And she would also apply at her full retirement age, and she would receive $1,200. Even though she didn't qualify under her own, she will receive 50% of her husband's benefit due to being married, right? So, and waiting until full retirement age. So now this family is now bringing in $3,600 a year in income that they don't need to take out of the retirement savings.
And we have a question, I think,
Sure.
that fits perfectly with this. Would you have to be at least in your 60s of, any age in your 60s to claim on Social Security via your spouse's benefit?
So yes, so you need to be at least 62. Okay. 60, I said, was a magic number. That's for survivor. But for actual retirement benefits, when we're talking here, 62 is the earliest you are able to apply. If you're claiming on your spouse, because you don't have earned the income, then you don't have a retirement benefit, that spouse also needs to be 62 and has had to claim.
Right.
So that's the biggest caveat is even if they're 62 but they haven't claimed because they want to delay their benefit, you can't claim on their record any longer until they file a claim.
Great.
That's changed a bit. They closed some loopholes. So here are the rules. If your marriage for your rules for divorced spouse benefits. So this is the divorced spouse benefits. Again, this does not affect your divorced spouse or if they've remarried. But if your marriage lasted at least 10 years and you're currently unmarried, and if your ex is at least 62, then you may be entitled to a divorced spouse benefit. If the divorce occurred more than 2 years ago, then they do not, the ex does not need to have filed. So that's where it's a little different than when you're married benefits that I said that they have to claim. But a lot of times, there's no discussion, no communication, so you wouldn't know whether or not they claimed. So Social Security allows you to claim as long as they are 62. They do not have to have claimed for their benefit. However, if the divorce, if you do claim at 62, you're still going to get that reduction. So it's something to think about. Does it make sense? And there's still an earnings test. So remember, there's still an earnings test, whether you're divorced spouse benefits or regular benefits, if you claim prior to full retirement age. Survivor benefits can be claimed as early as age 60. I said 60 was the magic number when it comes to survivor benefits. You can actually claim at 50 if you're disabled. But remember, if you claim at 60, this amount is also reduced. Anything prior to full retirement age is reduced. I know I'm drilling that, but it's so important to know and understand how these benefits work. So if you're a young widow, you shouldn't automatically file for your survivor benefit as soon as you turn 60. You want to analyze all of your Social Security claiming options before you decide when to file. And that's what we do. We help. If you have an advisor here, they can run the analysis. We have software that helps us take a look at what those benefits and when it makes the most sense to maximize your claiming, when to claim, how to claim, which benefits to claim. Because like I said at the beginning of this, you may be entitled to one or two. You may be able to claim on yourself plus a survivor or an ex. So to qualify for a survivor benefit, you must have been married to the person who passed away. I know that sounds crazy, but living together doesn't count. And that's what I mean by you have to be legally married. If they died during the marriage, you only had to have been married 9 months. So if it was early on, there's no 10-year. That's for divorce. So if you died after you divorced, that's where you had to be married at least 10 years in order to claim that survivor benefit. By the way, same-sex couples can now get Social Security benefits if they are or were legally married. Again, not just living together, not common law, but must have been legally married to be able to claim these benefits from same-sex or okay, so divorced spouse benefits, same as survivor benefits. So married at least 10 years, and you're currently unmarried, or your remarriage took place at age 60. Here we go, 60 again, right? So if your ex dies, and if you're either unmarried or you remarried at age 60, you may qualify for a divorced spouse survivor benefit. A lot of women won't think of this, especially if you got divorced years ago, never remarried. You think, I don't even know if I qualify. You may not even know that they passed. So that's also something you want to keep in the back of your mind is not following them, but you may be entitled if they did pass away. In this example, Sam and Sue were married from 1970 to 1985. So they were married for 15 years. Sam died 10 years later, unfortunately, but Sue never remarried. So as soon as she turns 60, she is eligible for reduced divorced spouse survivor benefits. Again, it would be reduced. And the earnings test comes into play. So if you are still working, you could have a reduction due to that earnings limit. So it's something to think about. Also, as I was thinking through the 60, the other thing to think about, whether it's divorce spouse survivor benefits or just survivor benefits, once you hit full retirement age, survivor benefits do not earn delayed credits. So once you're at full retirement age, figuring out how to claim your own benefits versus survivor benefit, a lot of times we'll tell clients to claim that survivor benefit at full retirement age, let their benefit continue to grow and get delayed credits to age 70, and then switch to the higher benefit if that's what happens through those calculations. So again, how to maximize. So just to summarize what we've been talking about, if you think you might outlive your spouse or your ex-spouse, and odds are that you will if you're female, and because we said we live a little bit longer, you'll want to encourage your spouse to wait until age 70 to start their benefit. Then you'll want to claim your survivor benefit at your full retirement or later, most likely full retirement age for survivor benefit. Again, it doesn't earn delayed credits. And hopefully, you'll be way over full retirement age before your spouse passes. But this is just some information you want to keep in mind. And then you just want to coordinate that survivor benefit, like I said, with your own retirement benefit. So let's talk about remarriage, right? Because, we get divorced. Some of us say we'll never remarry, but hey, we remarry. And some of us remarry before age 60, but we're seeing a lot more gray divorces, right? Mm-hmm. Kaitlyn and I have seen quite a few individuals getting divorced after the age of 60. So if you're divorced or widowed and you're thinking about remarrying, here's some rules to keep in mind. If you remarry at any age, you can receive a divorced spouse benefit. So if you're already receiving divorced spouse benefits and thinking about remarrying, understand that your divorced spouse benefit will stop. However, you may be eligible on a spousal on your new spouse benefit. If you remarry before age 60 and you cannot get survivor benefits or divorced spouse survivor benefits. Again, 60 is the magic number. However, if you marry after age 60, you can get survivor benefits or divorce survivor benefits. And I know there's a lot here, but we did have a client who was getting married, mm-hmm. and she was going to be eligible. She was 59 and she was going to remarry. And her previous spouse had passed. And I think they were going to get married in March, and she was turning 60 in May, somewhere in that range. And I said, I know this sounds crazy, but if you wait until May to get married, you'll actually receive survivor benefits on your previous husband. But if you don't, then that goes away. So they actually delayed their marriage from March to June to take advantage of the survivor benefit, because it was quite hefty, mm-hmm. What she would receive, and it was only a few months. And I know that sounds crazy, but you might as well let the system work for you. So with that, if there are questions, please don't hesitate to reach out to us. This is very complex. Social Security Administration can answer some of these questions. They usually don't give you the best advice, I'll be honest, and don't really understand how to maximize. So talk to your advisor, or if you have questions, give us a call. I'm now going to turn this back over to Kaitlyn. We just talked about retirement. We talked about Social Security. Now we're aging and coming into long-term care.
So just as retirement planning for women is an increasingly important topic, so is long-term care planning. I'm sure we have more than a few viewers who are either maybe going to be in need of care shortly or have been a caretaker for a parent or a partner. In the U.S., as Beth said, women have outlived men for over a century, and women are expected to live at least 6 years longer than men. And this gap is the widest that we've seen it since 1996. So we're definitely living longer. So let's start by seeing how much has changed in health and how Americans are faring in regard to mortality. Since the year 2000, breast cancer is down 2%, heart attacks are down 14%, strokes are down 23%, all while, unfortunately, Alzheimer's are up 71%. That is quite an alarming figure, considering that from these listed medical conditions, Alzheimer's is what's going to land you, sadly, in a long-term care facility. Sorry, no, you're okay.
I was doing so good.
It's a lot easier to develop a plan for any care that you may need in the future if you approach planning in a step-by-step manner. We'll go into what each of these steps mean in a minute, but to get an idea of what these steps are and what you should consider while implementing your plan. So first, picture your care. What will your care look like? Are you going to stay at home? Will you move to a care facility? Second, provide that plan to your vision to your advisors. So your advisors for long-term care planning are most likely going to be your financial professional, your insurance agent if you're looking at long-term care insurance, and even possibly your attorney. We'll get into a little bit of strategy that you can use when it comes to some trusts. And third, it's important to discuss that plan with your family and to relay what you have planned for your long-term care for a few reasons. Should you suddenly be unable to communicate your wishes, your family's already going to know what you have planned, and they know that this is what you want and that they're making the best decision possible for you. After you have a plan put down on paper, we want to make sure that you have the funds for your plan. So, as I said, what are your care options? What is your care going to look like? You may want to receive care at home. Maybe it's in your own home or in the home of a family member, of a friend, but you're staying at home, you're not going anywhere. While some people may want a family member as their caregiver, others may prefer care from a professional or a home health care service. Even if you're living at home, a person, you may need community services such as Meals on Wheels, other organizations that come in and do activities with elders and help them just keep social skills up and keep them happy. And if a person is living with family but they can't be left alone, you might need adult daycare services for an individual to go while your loved one is at work. Some people may want the professional services that a care facility can offer, and assisted living can provide care when staying at home is no longer an option. And the good news is that many of these facilities offer apartment-style living where you can still, bring your favorite personal possessions, your jewelry, your clothes, your furniture, while you're getting the care of a professional around the clock. And some of us may also prefer to avoid a nursing home care facility and this type of environment in general. And in the last few years, we have seen that more boutique type of care services, such as foster care for the elderly and more expensive high-end concierge care, have gained in popularity. So we need to fund our plan. And if we're using long-term care insurance, there are multiple types of policies that we can look at. So a traditional long-term care policy will provide the most long-term care coverage with the least amount of money. There may be features available with this solution as well. But this solution is for people who do not want or need life insurance, as it only pays long-term care benefits if you need qualifying long-term care services. The premiums on these policies are not guaranteed, and they can be raised in the future for an unlimited amount. But this is all under the state's approval. So there is some control over it. Currently, only lifetime premium payment schedules are available with most companies. These policies offer a monthly benefit for a certain number of months and years until the total lifetime benefit has been exhausted. There's also a life insurance with a long-term care rider policy, and this is for people with a life insurance need, but also have long-term care concerns. These policies have also become increasingly more common. The death benefit can be accelerated for long-term care benefits, but if the long-term care is very little or never needed, the remaining death benefit will be paid to your beneficiary. Some solutions are guaranteed both premiums and benefits, and there are flexible premium schedules available. So this solution provides the best leverage of death benefit, but also will provide the least in long-term care benefits. And then we have a linked benefit long-term care policy. And these are for individuals whose primary need is long-term care, but want cost recovery if long-term care is little or never needed. This policy has a death benefit that is guaranteed to be at least equal to or better than the premium paid. So the death benefit will not enjoy the same leverage as the death benefit on life insurance with a long-term care rider, but it will always, at the very least, provide a cost recovery of premiums paid if the long-term care benefits are not needed. These policies can be purchased with a single premium or with a premium payment schedule of up to 10 years. So now let's look at how long-term care benefits may be paid. And that means understanding the difference between indemnity and reimbursement plans. We'll use a hypothetical example here. Our insured owns a policy with long-term care coverage of $7,000 per month and is receiving care at home at a cost of $3,200 a month. Reimbursement plans only reimburse for the actual cost of qualifying care. In order to determine the amount of the reimbursement, all bills and receipts need to be turned in each month. Some insurance companies offer reimbursement plans with coordination directly to the service or the facility, and they'll just pay that directly. But keep in mind that reimbursement policies have limitations and do not cover all expenses a person may consider necessary for their care. So there may be items or services on a bill that will not qualify for reimbursement. Maybe getting your hair done at the facility or massage therapy. So those expenses will have to be paid out of pocket. In our example, there are $3,200 of qualifying expenses, so that's what the reimbursement policy will pay. There are no extra benefit dollars for other expenses that the policy does not cover. Indemnity plans, on the other hand, pay long-term care benefits directly to the policyholder. Indemnity plans, they're not concerned about getting those receipts and bills, and they're usually, just going to pay, not require a proof of billable services. You'll want to check with your policy, the policy details to determine, if any bills are required to be submitted just for proof that you are receiving any type of long-term care just in general. But so in our example, we have a full $7,000 is being received by the policyholder on the indemnity plan. And after paying the care service of $3,200, there is $3,800 remaining that can be used for any purpose. These dollars could even be saved and reinvested to begin building a secondary source of income should the policy benefits run out while you're still in need of care. Cash indemnity plans are similar but more flexible than basic indemnity plans. Once on claim, bills and receipts do not have to be submitted to prove billed services were used. The insurer places no restrictions on how the benefits are used. Thus, the long-term care benefits can be used for whatever care or services are needed by the individual. 100% of the benefits can be used to pay for an informal caregiver, including an immediate family member. So if you have a family member that has to give up work to come in to take care of you, they can get paid from your policy. So you might also just be wondering, how does an individual get on to claim? To begin receiving benefits, the insured must be unable to complete 2 of the 6 daily living activities. And those 6 daily living activities include bathing, dressing, transferring to and from a bed or a chair, unable to walk, using the toilet, or eating. Once the insured needs assistance with 2 of these activities, they are usually eligible to begin receiving their long-term care benefits.
And I would say a lot of individuals don't understand the difference between reimbursement and indemnity, or know which policy they have. So if you don't have, an agent that you can go back to, you'll want to call the company and make sure that you understand what type of plan you have. So when you're claiming,
Yes,
it's really important to know what they're actually going to cover and what kind of check you're going to get.
absolutely. So the core of insurance is to transfer the risk off of yourself and onto the insurance company. Some individuals may be in a position to be able to self-insure their long-term care needs, but there are obstacles to long-term care that insurance can help cover. To be able to self-insure, an individual must have the resources to fund their long-term care. Individuals who are considering self-insurance or self-funding need to have enough principal to generate growth to cover the cost continuously and to not deplete their initial pool of funds, especially if you're still looking to leave dollars behind to heirs. We never tell people to worry about leaving to heirs, but it's something that everybody wants to do. This requires advanced planning to make sure that you're properly allocated to adequately grow your dollars. If individuals are able to get long-term care insurance and to cover the cost of the premiums, it'll prove advantageous should they have a long-term care event. This is a peace of mind insurance to make your life easier as you age. The largest barrier to getting long-term care insurance is usually the cost of the premiums and the strict underwriting process. So individuals should probably consider long-term care insurance between the ages of 50 and 60. Usually by this time, you're in a position to better be able to afford the premiums and still healthy enough to qualify for coverage. And there is some opportunity for business owners here to get long-term care and do it in an advantageous way. So if you are the owner of a C Corp, you're able to offer long-term care insurance as a benefit to your employees and to yourself, assuming that you offer a life insurance with a long-term care rider. Your company could pay and deduct the premiums on those policies, and the employee would only be taxed on the portion of the premium that's associated with the life insurance. And that amount would be determined by the provider of the insurance. The long-term care benefits would still remain a tax-free benefit to the employee once they're on claim. And if you own an S Corp, you can provide a similar benefit to your employees, but you as the owner, you're not eligible for quite as advantageous benefits on this. And so many individuals plan for their care is Medicare. And what many do not realize is that Medicare does not cover as much as they think that it will. And it does not always provide the standard of care that they would like. So Medicare will only cover skilled nursing care for 100 days. And in addition to the limited covered days, these 100 days must be followed by preceded in a 3-day, minimum of a 3-day hospital stay. And home care is also limited as well, as it's only available for rehabilitation and for hospice. So relying on Medicare solely as your long-term care plan is not going to be sufficient for your
It's not a long-term care plan.
No. So the last resource that many individuals have in late life care is Medicaid. And one thing that when you're choosing a care facility, I think something you want to consider is seeing if this facility is a Medicaid facility. This means that once you're unable to pay for the facility, whether it's your self-insurance or if it's a long-term care policy, the facility will allow you to stay there and they will begin to get paid via Medicaid. And this is also usually required after a certain amount of time that you've paid into the facility. So individuals who plan to go on Medicaid immediately need to understand that there are strict requirements to qualify for Medicaid. We'll cover those requirements shortly, but first we'll go over some options to qualify for Medicaid ahead of time. Gifting to family early is one option. Any gift completed 5 years ahead of Medicaid would be excluded from the 5-year look-back period. You may also consider establishing an asset protection trust. While the 5-year look-back still applies, if you plan ahead early enough, you have the opportunity to shield your assets well in advance of a possible long-term care event. So what is an asset protection trust? And I'll briefly go over this, but this is where you would want to start to consult your estate attorney. So an asset protection trust is what we call an irrevocable trust, meaning that the transfers made to the trust are irreversible and the assets are no longer considered to be your personal assets. While the idea can be a little unsettling to a lot of individuals, you do still retain control over these assets indirectly. You become the grantor and you're also named as the trustee, and your heirs are named as the beneficiary. As the grantor, you retain the right to change your beneficiaries at any time during your lifetime, and upon your passing, the assets inside the trust will be paid to your heirs and are not considered to be part of your estate if we get past that five-year look back. You have access to the funds within the trust through your beneficiaries. As the trustee, you can authorize a disbursement from the trust to the beneficiary, which are usually your children, and a few days later, the beneficiary can write a check directly back to you for you to use for your care or whatever you may have needed those funds for if we're still before a long-term care event. So what if the beneficiary doesn't send the funds back to you? I think is usually the biggest concern that individuals have on this. Well, you still have the right to change the portion that they'll receive at your passing or to remove them as beneficiary altogether, which is usually enough reason for them to quickly get a check back in the mail to you with those funds. And failure to plan ahead and taking advantage of these options is what's going to result in a Medicaid spend down scenario. And I'll just quickly go over the restrictions that Medicaid puts on your assets. So as I noted, it's a strict asset limit to qualify for Medicaid benefits. In the state of Pennsylvania, an individual can have no more than $2,400. If that individual does have limited monthly income less than $2,382, they're able to have $8,000 worth of assets. Still not very much at all. And any transfer, as we said, count within the last 5 years will be considered in this asset count. And considering the cost of care, spending assets down to this level will come quickly, as the average cost for private nursing care in Pennsylvania is just under $12,000 a month. And in West Virginia, it's a little over $12,000 a month. So you'll get down to that asset level, but your assets will be going to a facility and quickly. So there are some assets that are exempt from a Medicaid spend down, although a Medicaid state recovery program will usually come in and invade that estate to repay back some of the costs to the state. So individuals are able to keep a house, and this is also for a couple. So if one couple, goes into a facility and they end up on Medicaid, they're not going to make the surviving spouse give up their home. So they're able to keep a house, one vehicle, a prepaid funeral plan, and your personal property, your clothing, your jewelry, furniture. Your spouse is able to keep their qualified accounts, so their IRA or other accounts designated as retirement assets. And this also includes a Medicaid compliant annuity. And what is countable towards that spend down? What do we have to get rid of? Real estate that's not a primary residence, so a vacation home, a rental property, additional vehicles, investment accounts not designated for retirement. This includes your brokerage accounts with stocks, bonds, mutual funds, checking accounts, savings accounts, your personal retirement accounts, and the cash value in any life insurance policies that you have. So as we said, Medicare, Medicaid, it's not a long-term care plan at all.
And I know we went a little over, and we had a lot to cover.
We did.
And a lot of slides. And so we're going to go through some of these questions here for a little bit. If we don't answer your question, we'll make sure that if you have an advisor that you work with, we'll make sure that we get the questions you've asked to them so that they can answer your questions. And if you have others, please feel free to reach out to myself or Kaitlyn to discuss. And then we also have some upcoming webinars in September and October. So let's see, we had one that, can you claim ex-spousal benefits at 62 while allowing your own benefit to grow until you hit age 70? So maybe, and this is why I kept saying you may be eligible. So if your benefit is actually higher than that spousal benefit, or more than 50%, I should say, if it's more than 50% of your spouse, then you cannot claim on an ex-spouse. So depending on what your benefit amount is, will determine whether you're actually eligible to claim on an ex-spouse. So it's always your benefit first before your ex's. So you may be able to do that. Again, there's some caveats to it, and you might be able to get that benefit and then let yours grow. But for the most part, you just have to look at how much that benefit is. If you are between a 60 and 62, I know there are earnings limits in order for a surviving spouse to collect on a deceased spouse Social Security. Can you please share that amount? It's the same. It's that $22,320 for this year. It increases. The earnings limit is the same whether surviving or early. They just have that earning limit. It just stays the same whether survivor or if it's early retirement benefit earning limit. Does this include survivor pensions? When it comes to pensions, that's where it does get a little complex. So it just depends on what type of pension it was. Your benefit could actually be reduced if there was a pension from an individual that was in a government job and maybe did not actually pay into Social Security, where your benefit could actually be reduced because of the pension.
Yep.
So please, those are definitely more complex. We can run those, we can let you know, but it does depend on how that pension, if that is a private pension or a public pension, will determine whether or not your benefit is decreased. It's called a windfall, the WEP, and then there's a GPO, so a government offset on benefits. So can you jump back to, October.
Yep.
Sorry.
Is there anything on our pre-written
Yes.
questions?
Let's take a look at that. There was a few. There was one that I know. When a client doesn't have long-term care or long-term to invest, what's a good strategy? Doesn't have a lot of time, I guess, is what they're asking.
Mm-hmm.
When a client doesn't have a long time to invest, what's a good strategy? I would say, quite honestly, save as much as you can in the short amount of time, whether that is through your employer plan, whether it's a corporate plan, a 401k, you're setting yourself up. You want to try to reduce your income, or not your income, your expenses, increase your income and your savings as soon as possible. It's never too late to invest, to
Yep.
start investing, but discipline yourself. So, even if it's dollar cost averaging, putting $50 or $100 a month, you want to get as much put away. Take advantage of either IRAs or Roth IRAs to also grow different buckets, different taxable buckets, so that you have some options in retirement.
And with those 401ks, you get employer matches, and make sure that you're taking advantage of those in the full amount. So if they require 3% or 4% to match, make sure you're at least putting that in to get that free money, as we like to refer to it as.
Absolutely. One of the questions we had also is, what's the most overlooked planning step for women? And we were thinking about this actually as we got this one in, and we threw a few things out. We said, the Social Security claiming is a big one, but we really came back to not being involved. It is interesting to both of us as to when we see married couples come in, we might see both at one point when they first start the process, but a lot of women don't get as involved. And so I would say it's changing with the different generations, but the older generation tend to leave a lot of the investing and the planning up to the husband, and in which case they're not involved. So I would say the biggest overlooked thing is not being involved, understanding what the plan is in place. What if that person, something happens to your spouse who took care of all of it, knowing where everything is, how to access it, who to call. I know we try to require that the spouses join us at least once a year, in no matter if it's male or female, because sometimes we have the female who is really running and does all of the investing. But I would say the biggest overlooked is just not being involved in the investment or the retirement planning and understanding the holistic approach of wealth management.
And as we said, for the women who aren't as involved, women tend to live longer. So it's pretty likely that
You're going to take care of your finances.
you're going to be doing it on your own one day, And that's why we try to encourage them so strongly to come in, to get involved, and to be a part of the conversation.
Sure, absolutely. And I'll end with this one just because I thought this was also a good one. As I am about to turn 65 and I am still working, what do I have to sign up for when do I start to take Social Security given that I plan, oh, it cut off. But I'm gonna take part of that. So when you turn 65, you do not have to. This is something that is a myth, that you have to sign up for Medicare at 65. If you recall, Social Security and Medicare used to be at 65 together. As soon as you signed up for Social Security, you were on Medicare. That used to be the full retirement age. That is no longer the case. If you are working and you are 65 and you have a health savings account, an HSA, you are not allowed to contribute to that health savings account if you sign up for Medicare. Please do not sign up for Medicare if you're still working and you have a health savings account. And if you did, you need to get those dollars out because they will be, there's a penalty. Yes, there's a hefty penalty if you contribute to an HSA and sign up for Medicare. Sounds crazy, but do not do that. When you want to start, when you're going to retire, you can sign up 3 months beforehand. Make sure you stop those HSA contributions, and then you have you basically have 7 months, 3 months before, the month in, and 3 months after to set up for Medicare. But if you know when you're going to retire, plan that. Talk to your advisor. Think about your HSA contributions, and then when to start taking Social Security. Depending on what your income level is, how much money you need, what you're making is going to determine. Like I said, if you can hold off on taking your Social Security to age 70, if you are the breadwinner, if your benefit is the highest, hold off to age 70. Otherwise, I would say at least to full retirement age. If you are a single individual, and you're still working and you do not need those dollars, let the delayed 8% come into play. If, however, you do need some income and you've been taking money from your investments while you're still working, then yes, there's times where I say claim Social Security, especially if there's not a survivor.
Yep.
So with that, I'm going to end. I know we're a few minutes over. We are so happy that you've joined us. And I know there are a ton of other questions that we did not get to, and I apologize for that. But please feel free to reach out to your advisor or ourselves. We'd be more than happy to have those conversations. And thank you again for your time, and we look forward to seeing you at future webinars.
Absolutely. Thank you guys for joining us.